The S&P 500 just crossed 7,000. 3 straight years of double-digit gains. Corporate earnings growing at their fastest pace since late 2021. AI is everywhere, and yet the Fed isn't cutting. Inflation is quietly coming back. And if you've just been buying everything with AI in the name, you might actually be underperforming right now. So is this still a bull market? Or are we one bad data point away from something very different? I ran Nvidia and Google through Invyra's models. What came back surprised me, and I'll show you exactly what I found. In this video, we're breaking it down into 3 parts. Part 1, the bull market everyone sees, and what's quietly changing. Part 2, what's really driving this market, or Freeman, the opportunities and the risks. Part 3, Nvidia and Google, what the data actually says. Let's set the scene, because the headline numbers are genuinely impressive. Q1 earnings for the S&P 500 are tracking mid-teens double-digit growth year on year, the strongest we've seen since late 2021. Around 80+% of companies beat expectations. The AI CapEx boom is still the central story on Wall Street. On the surface, this looks like a market that has every reason to keep going up. But here's what the headline doesn't tell you. Underneath the index, there's a massive rotation happening. Some sectors are surging, others are quietly losing ground, and the investors who are just holding everything are starting to feel it. So the real question isn't whether the market is up, it's whether it deserves to be, and what's driving it from here. Here's how most people are thinking right now. Bull market. AI is booming. Just stay in big tech and ride it. And I get it. That's literally what worked for the last 3 years. But 2026 is a different environment. Markets are now pricing in 0 rate cuts for the entire year. Inflation is stickier than expected, and the companies priced for perfection, they now have to deliver quarter after quarter with no room for error. The game has changed. And the investors who recognize that early are the ones who will outperform. So that's the surface story. Strong earnings, AI boom, and a market that looks like it has every reason to keep going up. But is it actually as strong as it looks? Because when you dig into what's really driving it, the opportunities hiding underneath, and the risks most people aren't pricing in. That's part 2. There are 3 real opportunities right now that most investors are missing, and 3 risks that could change everything. First, earnings are genuinely strong. This is real, not hype. Mid-teens earnings growth year on year. And the rest of the S&P 500, outside the Magnificent 7, is finally starting to catch up. When earnings grow, stock prices follow. It's not complicated. And right now, earnings are growing faster than almost anyone predicted. Second, the AI build-out is creating a second wave, and most retail investors are missing it. The real second wave isn't about buying Nvidia. It's in the infrastructure behind AI. Data centers need power, massive amounts of it. Energy companies, industrials, utilities, they're all becoming quiet AI plays. Third, there's an expectation of a more business-friendly regulatory environment. Less red tape, a wider window for M&A. If that plays out, companies can consolidate faster, grow earnings through acquisitions, and re-rate higher. Early signs are already visible, but here are the risks. And I want to be honest with you about all 3. Risk 1, markets are pricing in 0 rate cuts for 2026. Not 1. For 2 years, bulls said, just wait until the Fed cuts. That's when growth stocks re-rate higher. Risk 2, inflation is quietly coming back. This one doesn't get enough attention. Energy prices climbing, Middle East tensions unresolved, supply chain pressures re-emerging. This means we must prepare for a period of instability. When inflation stays sticky, the Fed has no reason to cut. JP Morgan's current base case actually has the Fed's next move as a hike, not a cut, sometime in 2027. That's not what most investors are pricing in. Risk 3, AI valuations have zero margin for error. And this is the one I think about most. The market is assuming S&P 500 earnings grow 14 to 16% this year. And for the AI adjacent names, valuations are pricing in a very optimistic version of the next 3 to 5 years. If any major AI company misses expectations, or a hyperscaler cuts its capex budget, the repricing could be fast and brutal. Okay, so we have the macro picture. Strong earnings, AI tailwind, but Fed headwinds, sticky inflation, and rich valuations. Now here's the question most people can't answer. Given all of that, are Nvidia and Google actually priced correctly right now? I ran both through Invyra's IV engine using institutional-grade valuation software, which is built with state-of-the-art algorithm to provide unbiased intrinsic value, not influenced by market emotions. Here's what came back. Invyra's models put Nvidia's fair value at around $189.83. Current price, $220.78. You're paying roughly 16.3% above what the models say it's worth. Does that mean it's a bad company? No. Nvidia's moat score, ROIC, earnings trajectory, all genuinely strong. But at this price, you're not paying for what Nvidia is. You're paying for what it has to become. That's a very different risk profile. And if you want to go deeper, ask Invyra's AI assistant directly. Is Nvidia overvalued right now? It pulls from the same data and answers in seconds. Now here's the interesting one. Google. The market has been treating Google as not AI enough because it doesn't have the same data center capex story as Microsoft or Amazon. But look at the underlying business. Search, YouTube, Google Cloud, all growing, all profitable, all throwing off real cash flow. Invyra puts Google's fair value at around $273.77. Current price, $387.35. That's roughly a 41.5% higher to fair value. This is what I mean by the rotation hiding in plain sight. The market is chasing the narrative. Invyra is looking at the business. Full transparency. I'm holding Nvidia and a few other large cap tech names. So I have skin in the game on this call. I also used Invyra's AI assistant to pressure test my assumptions. You can ask it the same things I did. Is Nvidia overvalued? What's Google's moat score? And it answers from real data, not opinions. No valuation model is perfect. What I'm using this for is to structure my thinking, not to outsource my judgment. So where does that leave us? I think 2026 is a bull market, but a mature one. The easy money has been made. From here, it's about being selective, knowing which businesses are genuinely cheap versus which ones are priced on hope. Personally, I'm holding my Nvidia position, but not adding. I'm watching Google closely. If it pulls back another 5 to 8%, I'll probably start building a position. And I'm paying a lot more attention to the sectors I'll cover in episode 2, energy, industrials, utilities, because that's where I think the next leg of outperformance is hiding. If you want to run Nvidia, Google, or any stock on your watch list, check Invyra. It uses institutional-grade valuation software built with state-of-art algorithm to provide unbiased, intrinsic value, not influenced by market emotions. And the AI assistant is live. You can literally open it and ask, should I be holding Nvidia in the rest of 2026? And get a data-driven answer in seconds. No credit card, free for now.